In case you missed it, central banks and base rate decisions took centre stage in September. So I'm going to break down what happened in the US and the rest of the world and look at how all of this impacts the stock market and your investments. Hi, I'm George, Founders Investing Expert. This month we partnered with eToro to bring you all of the latest market news and insights from the past month. If you're interested in more content like this, do me a favour and make sure to like below and subscribe to our channel. Okay, so to kick things off, we need to talk about the whopper base rate cut from the Federal Reserve in the US. A rate cut was anticipated from the US Central Bank, but most analysts were expecting, a 0.25% drop. But America loves to supersize everything, so whilst other central banks from around the world were making smaller, 0.25% cuts, the Federal Reserve got together and decided to double down and lower its Fed funds rate by 0.5%. Before I jump into what this means for the market, I'm just going to quickly explain how the US actually cuts rates, because it's pretty interesting. When the US Federal Reserve decides to cut rates, unfortunately, they don't have a big pair of magic scissors that reduces the cost of borrowing. Instead, they control and manipulate something called the federal funds rate, which is the rate that banks in America charge to borrow from each other on a short-term basis, and it's usually overnight. However, it's actually a range rather than a fixed rate. The Fed funds rate has been sitting at 5.25% to 5.5% since July 2023. And the recent cut on the 18th of September means that this target range has been lowered to 4.75% to 5%. So it is a 0.5% drop, but it's not one stationary figure dropping down to another stationary figure. The reason that it's a target range rather than a set figure is because the Fed can't actually force banks to charge specific amounts. So it usually lends to banks itself at the top of the target range, and then it buys and sells debt on the secondary market to tinker with things. It's a bit of a complicated process, but this is why it often takes a bit of time for these changes to actually filter through and really kind of impact important financial areas like mortgages and borrowing costs. Now, what it does tend to have an immediate impact on is the stock market. And the reason for this is that the stock market is forward-looking. So although the rate cut from the Fed doesn't necessarily have an immediate financial impact, it does create better economic conditions for the future. This is why these cuts can impact the stock price or even the whole market as soon as it's announced. Even though it may not save companies money right away, it does set the scene for a better environment down the line. All right, that's the end of the economics lesson today. So let's look at what actually happened with stocks. Shortly after the Fed announced its bumper rate cut decision, we saw, a small positive bump in the overall US stock market. And a quick way to look at that is using the S&P 500 index, because it gives you a simplified snapshot of things. And an incoming rate cut was already priced in, so there wasn't expected to be much movement. But because this rate cut was larger than most people were expecting, it did result in slightly more positivity. And I've mentioned this a lot recently in our update videos, but markets are all about expectations. And it tends to be the unexpected events that have a bigger positive or negative effect on stock prices. Personally, I think that the Fed has played a bit of a blinder here. It's actually one of the last major central banks to make a base rate cut, and people were starting to get worried that, they'd waited too long and America was actually heading towards an economic slowdown or even a recession. And this is something called a hard landing in finance lingo. In reality, I think this is the kind of reaction that the Fed was after. Muted positivity with a sprinkling of doom and gloom. And the reason I think the Fed will be happy with this response is because the whole point of raising rates in the first place was to tackle high inflation and pour some cold water on the economy. As inflation in the US started coming down, the Fed released comments, I think it was the end of last year, saying that they expect to carry out multiple base rate cuts. And this kind of sent the stock market into overdrive with a sense of exuberance. But that's exactly the sort of overconfident behavior that could lead us back into an inflationary environment. So the Fed needed to wait until both the data was pointing in the right direction and the predicted overall response wouldn't be too upbeat. They basically needed everyone to feel a bit grumpy and a bit meh about the rate cut, because that's going to mean a gradual return to positivity rather than just blasting us back into an inflationary environment. So bravo, Jerome Powell, the chair of the Federal Reserve. With the wider market ticking up since the rate cut, we seem to be in a fairly stable position headed into October. And interestingly, some of the recent growth in markets has been from kind of more defensive stocks like Walmart and Next Era Energy, rather than the high-flying growth options like Alphabet and Nvidia that have been the stars of 2024 so far. And this backs up my theory that overall, investors aren't too impressed by the state of the economy, so they are looking towards more stable stocks that tend to make money even when there's a slowdown or a downturn. However, analysts at Morgan Stanley have said recently that people should take profits, i.e. sell defensive stock positions, because many of these stocks now seem overpriced. But this is why it's often best to keep a diversified investment portfolio that's going to perform during all sorts of stock market environments, so you don't have to worry so much about stock sector flavors of the month. And of course, your investing decisions are completely down to you. You don't have to listen to anyone at Morgan Stanley. You don't have to listen to anyone else when you want to buy, sell, or hold a stock. It's completely a personal decision. In slightly less exciting news, the European Central Bank, the ECB, decided to lower its base rate, officially called the deposit facility rate, to 3.5%. And again, it did lead to a bit of muted positivity with the European stock market, but it was nothing to write home about. Over in Japan, it's back to business as usual, as the Bank of Japan decided to keep rates where they are, opt in against another raise, seeing it as they did that last month and it shook up global markets. And if you want to kind of have a bit of a deep dive into that disaster, you can check out our previous video. And here in the UK, the Monetary Policy Committee at the Bank of England voted 8-1 to hold rates where they are at 5%. The good news about the Bank of England sticking to its guns is that a higher base rate can lead to a stronger pound. So if you happen to be buying investments based in Europe or the US, you might get a bit of extra bang for your buck when buying these investments using your pounds. Although different trading platforms do have varying foreign exchange FX fees for converting your currency, so watch out for those. We've also seen China jump on board with the People's Bank of China, the Chinese central bank, introducing some long-awaited economic stimulus, including cutting key interest rates and hinting at further rate cuts to come, which has helped act as a catalyst for the biggest stock market rally that China's seen in the past 4 years. Are base rate cuts a good thing? It depends basically on the surrounding factors and largely whether these rate cuts are proactive or reactive. There's a big difference between making moves out of desperation and making them to get ahead of the curve. But in this instance, in today's global economy, so far, all of the action around rate cuts, particularly from the Federal Reserve in the US, seems to have given a bit of a boost to global stock markets. But whether this positive sentiment sticks around and carries on throughout October and future months does remain to be seen. Thanks for watching. Make sure you tune in next month. And if you want to check out our review of top trading apps like eToro, just click the I over in the right-hand corner or click here for our latest videos.